After we're talking about double exponential smoothing, which means exponential smoothing with a trend, we're also going to add a so-called seasonal adjusted data in here. The seasonal adjusted data, which means now I'm going to adding another smoothing factor called theta. Okay, fine. And actually is how much of the seasonal effect come into play. And here I'm going to using the livestock 2 data, and we'll show you how they looked in a minute. And we're going to build 4 different models. Okay, so this is a host method with adding with the seasonal effect. Let's take a look. All right. We're still going to using the host method. First is linear, exponential, damp, and then exponential with the damp. Okay, so we can see how the data was captured. So now you can see that I'm going to compare the model 2 and model 4, model 2 and model 4. Okay, see if they, and I can plot from the result. Actually, I'm plotting first is the level, see if, and the slope, and the seasonal residual of the portion. Okay, now we changing another example, and this example is from the source right here. You see where I get it from is I got it from last year, November 2019. That's the most current data from the last years. And then we using this retail trade in Australia. We can download this. Okay. And you can download more current data. We may be trying in homework or exam. So we call this Australia retail trade data executed. Okay. And we're going to see the data first. The data has 307 rows, and the first columns is the time, actually is the month and years, and second column actually is the turnover ratio. So we have a total 380 rows and 2 columns. I'm going to plot it out. Okay. Slightly large data set, and you can see that there is a uptrend also, and also there you see a clear so-called seasonal pattern up and down, and the pattern actually starts small and gradually the magnitude goes large. So this is a perfect example. You see your data not only have some variation or randomness, and also you see an uptrend, okay, uptrend, and also you see a clear pattern for seasonal effect. Okay, I'm going to see one more time. But here what I'm trying to do is first I'm going to convert the column 0 as a datetime column, and I'm going to use it as an index for this data frame. So first we're going to convert using a panda built-in function called pd.toDatetime. So I'm going to convert this column into a datetime information. The day column I'm going to convert and format is the month and the years. Okay, the capital Y represents the 4-digit years, lowercase y represents the 2-digit case. Okay, and the lowercase b represent the month is in the abbreviation with 3 characters for the month's name. So I should be able to convert it. Take a look. Now it's successfully converted into years, 4-digit, and month. And since it's only had months, I'm assuming it's at the beginning of the month. Okay. All right. I'm going to set, okay, the date column as a daytime index and make sure that the frequency is month. S means starting of the month, which is April 1st, May 1st, June 1st, and July 1st, and so on and so forth. You can also have a month end if you just using M, frequency of M. That represents end of the month. Okay, but here I'm just showing you MS represent the starting of the month. Okay, I'm going to set this into as a part of a index. So daytime index I have using as index portion, and now I'm setting it as index of day. Okay, actually I can drop the date column from that, and so for for later analysis. But instead of touching the original data frames, I'm going to create an Australia Retail 2 as just a Panda series instead of a Panda data frame. And I'm going to check the daytime index one more time. I'm going to set the index for the Australia Retail 2 as part of the index for the first. I'm just grabbing the first 100 data from the data frame. Take a look. Okay. And this is the index is daytime index with the frequency of the start of the month, and then one column called data. Here again, we have a 4 different model and 4 different model using exponential smoothing data, which is and using Australia Retail 2 as an input, seasonal periods, actually 12 month, okay, and using additive in terms of trend, using seasonal, either additive or multiplicative, okay, and some of the parameter using the damping trend as well, adding to it. So there's a variation of option you can use in these so-called seasonal effect type of thing. So, and this part actually fit the model. Okay. We create a data frame to collect the information of alpha, beta, phi, and gamma, which is 4 parameters, L and B's, which means the linear trend and the offset level trend, and the sum of square error into a result section. So I'm going to collect certain type of result and parameters. I'm using the smooth level, smooth trends, damping trends, and smooth seasonal, initial level, and initial trend. So these are the parameters I'm going to use. And I'm going to start fitting those models using the data we have. And finally, what we do is we're going to plot this historical data, which is only 100 point at this point. And then we're going to choose the first two model we have right here to see how well they predict the historical data and how well they project the future data without any historical data to base on. So here we have plot the result for the real value and their corresponding forecast. Okay, forecast, and then I'm going to carry a period of forecasts into the future, but without any historical data. And we're going to plot them all together in one picture. As you can see now, the blue line represents the original data, okay, the hold and fill and add. And then you can see the green line is the one we projected into the future. Actually, the blue line is the original data. The green and the red line represent the forecasts. Here we actually execute. Okay. And these are the, for each one of the model, and what are the optimal parameter alpha, beta, phi, and gamma, and level trend and a level trend and linear trend. Okay, and the sum of square error. All right, we can also convert these into a NumPy array to see that for this model, what we have, you can see for all the y represent the original data, b is the level, okay, and b actually b is the linear trend, and L is the level, and S is a seasonal effect. And you can see that also for the last 8 numbers in this data frame, and we don't have any other value except the forecast, because those 8 period we only have forecast projected value. We didn't have the original data right here, but of course we do, but we just pretend we don't, and we trying to estimate the last 8 period, and we append the so-called forecast value of the last 8 period, and we append it into the same data frame. So you can compare. The Y represents the original data, okay. B represents the level trend. L represents the linear trend, and S represents the seasonal trend. Okay, we can take a look at the first 20 of that. And here is a write-up for the Hose and Winters seasonal method, okay, and more elaborated. And I have explanation of each one of the method, how they work in mathematical format. Okay, we can do the Australia data. Okay, take a look. Damped method. So this pretty much giving me the forecast of various method I'm trying to use. Next, we say, okay, we learn all these technique. So far, we cover simple moving average, cumulative moving average, simple exponential smoothing, and double exponential smoothing, either linear, exponentials, or damping. And also, we're talking about using somehow real life data into the analysis, and he's showing you actually with the clearly pattern. You can see the black line represent the original data, and the green and the red dash line represent the forecast data. And you can see these method actually capture the seasonal patterns and the trend patterns quite good. And so now we're trying to see if these methods are so powerful and it can predict the data so closely. Can these methods be using for stock data or real-time data in the stock market. Here I'm just using a Dow Jones Industry Average. Is ticker you can get, and here's the link how you get them. Okay, and last year I using the data set from February 3rd, 2019 to February 3rd of 2020. But this year I'm going to just download like yesterday the Dow Jones from the February 16, 2020 to February 12 of 2021. So let's see how this data react to our model. These are the Dow Jones Industry Index on the day, okay, from February 12. First is February 18 of 2020, and the opening number, the height of the day, the low of the day, and closing number, and adjusted closing and the volume. So here what we have is totally 251 rows and 7 columns. I'm just going to using the closing index for each day. A couple things I need to do. First, I'm going to, of course, we can plot it first, and you can see the trend. Actually, in 2020 to 2021, there's plenty of activity going on. First is the dip for the coronavirus, okay, COVID, coronavirus, and then the stock market gradually recover. Then we have the trade war impact, and the several foreign policy, actually, U.S. government announced create some kind of a dip and volatility into the stock. But the general trend, it is still growing strong because the elastic quantitative correction basically means U.S. government printing money and inject it into a stock market. Okay, fun. So these are the general trends still going up, but we do have some dips and up and so on and so forth. We want to see how our model react to this type of information. And we print out one more time. I'm going to set the first convert the day column into a daytime format. Is a 4-digit year, which is capital Y, and AM it represents is your month, and then the day. So within the year, month, and day, there are dash represented. So we're going to find it out. We're going to convert it into a day, and then we're going to set it into a daytime index using the day as a daytime index. And then we can drop the day column, but here we're just going to use the closing information. Instead, I'm creating another data frame, and here what we have is I want to grab a portion of the this index number. I'm going to start with the 10 to before the last information. So, and grabbing 100 data. Okay, so from offset to 10, then I'm going to grab 100 data before that. So how do we do that? Here is, so starting day, I'm going to go -10. So it's 10 to the last. Okay, 10 to the last. I'm going to using also only the closing column, close column, and start with the starting day and go back to 100 day as my range. Okay, so this is only a panda series and not a data frame anymore since it's a single column. Then I'm going to borrow the column from daytime index moving to similar daytime information, moving to DJI2. So I'm creating another Panda series. So you can see, oh, sorry, I need to execute this one first, and the next one, and the next one. So we see it is that Panda series with one index called day, and rest of them just the closed data, and plotted it out also to show you how it looks like. Okay, so it is in the beginning of the February this year. We're back all the way back to the first part of the September 2020. I'm going to also using the similar form model. Okay, so here would I want to make a note here. Since you can see these data, since there's no significant or obvious seasonal pattern, so determining the seasonal period in these whole and winters method becomes very dangerous and not very intuitive. As opposed to the Australian retail trade type of data, we can clearly see some obvious seasonal pattern. But for the daily trading data of the Dow Jones Index, there's not really significant, maybe weekly trend even. But with these kind of deep valley, and this is kind of destroy the entire so-called seasonal pattern for some event happen on the market. But nevertheless, let's run this model similar. Okay. And you see they complain some of the information, say optimization failed to converge. And it's all because there's no seasonal pattern clearly can be used. So the model cannot converge to determine what is the best seasonal parameter for those. But still, they give us some data, and you can see, and there I'm just choosing two of the model, forecast 1 and forecast 2, which is the model 1 and 2 come out of this. And you can also still see actually the method closely follow the patterns of the Dow Jones index, and up and down, even with this dip, they kind of predicted that as well. And also you see the last two, actually the green and the red, represents the forecast into the future of A period, still A period, I think. Yeah, A period right here. For those two methods, I'm going to forecast into the future without taking any historical data. Okay, and you see that still they follow a pretty decent trend prediction. Okay, and these are the optimal alpha, beta 5, and gamma, L, and B, which is the level of trend and the linear trend and so on. And this is the sum of square errors you're giving for those four methods. So this table is kind of important, represented down here, and how you, where's that? Okay. Represented right here in the results section. Okay, how to set up the data frame to the fitting parameter and getting the result. All right. So this is pretty much summing up. But the conclusion is, okay, is there any better method to follow these trends? Okay, now we're talking about we including linear trend, exponential trend, damping trend, and including seasonal patterns. We including all the bells and whistles on these models, complicated model, okay? And some of the option we don't even know if they are good or not. So are there better method to study this information? So here is the final no. And the reason, even though we feel that these complicated model follow the prediction pretty well of even stock market data without clear trend and clear seasonal pattern. But next chapter, we going to start talking about next chapter. Next lecture, we're going to using the stats model library called seasonal autoregression methods and moving average. We combine autoregression and moving average together. And these type of method used to refer in your PPIC as a Box and Jenkins method, as invented originally by Professor Box and Professor Jenkins. And this is for time series, okay, autoregressive and moving average. Usually we refer them ARMA models, stands for autoregression and moving average combined model. And we're using the next lecture periods to go over these and giving you much more reliable prediction on the stock market type of market data for commodity, for future and contract and index. And we'll talk a little bit about their application in financial market. But today we're going to conclude our lecture here and this notebook.